Hello and welcome. As of June 2024, Indian government bonds have been included in JP Morgan's Emerging Market Government Bond Index Fund, one of the major global indexes that invest in government bonds of developing countries. This is significant news for the Indian economy, as it is expected to attract foreign inflows of approximately $20 to $30 billion into the Indian bond market. Now, this development is particularly good news for Indian investors because this will further boost the economic growth story of India. And in this video, I'll explain how this will benefit the Indian economy and also cover the potential risks associated with it. My name is Kanak and welcome back to my channel. For more interesting content from the world of finance, economics and investing, subscribe to my channel. In 2020, for the first time, the Reserve Bank of India introduced Indian government bonds through a fully accessible route, FAR, allowing non-residents, including foreign portfolio managers, to invest in these Indian government bonds. And 4 years after their launch, these newly introduced bonds are now included in JP Morgan's Emerging Market Government Bond Index Fund, a $213 billion fund. Now, the JP Morgan Bond Index Fund includes bonds from about 18 different emerging markets, with the weightage for each country capped at 10%. This ensures the fund remains well diversified across countries and is not dominated by a single emerging market. And according to this criterion, the weightage for Indian government bonds in this fund is capped at 10%. So a 10% weightage of India in a fund that is about $200 billion would result in an inflow of somewhere between $20 to $25 billion. Now, an important question to ask is, how significant is this $20 to $25 billion for the Indian bond market? As of 2023, the total Indian bond market was estimated to be about $1.9 trillion, with $1.3 trillion being government bonds and the remaining $0.6 trillion being corporate bonds. Therefore, $25 billion of $1.3 trillion of government bond is about 2%. So in terms of actual percentage impact on the Indian government bond market, this might only be in the 2% range. Even though the total impact in percentage terms is small, this inclusion signifies the beginning of something very important for the Indian bond market. With that said, let us now talk about the advantages of this inclusion. One of the biggest advantages is the diversification of government funding sources. With access to foreign funds, the government does not have to rely solely on domestic investors to finance its debt. This would result in more domestic funds being available for the private sector or increased borrowing capacity for the government itself. More capital available to the government or private sector tends to result in spending, which leads to economic growth. The second major advantage is the reduction in interest rates for both the government and private sector debt. When demand for bonds increases, their yield goes down. To explain it in simple words, when more investors want to invest in a debt, the issuer of the debt can pay a lower interest rate. With increased demand from foreign investors for Indian government bonds, the interest rate on these bonds will decrease. Additionally, private sector bonds are pegged to the government bonds, meaning the interest rate on private corporate bonds is priced as a percentage on top of the interest rates of government bonds. Thus, increase in demand for Indian government bonds will lead to decrease in interest rates for both government and private sector, which will result in lower borrowing cost. And when borrowing cost goes down, businesses borrow and spend money, leading to higher economic growth. The third major benefit is stability of Indian rupee and an increase in foreign exchange reserve. Now, I specifically mentioned the stability of Indian rupees and not its appreciation, because although the increase in demand for Indian rupee should result in appreciation, the Reserve Bank of India will aim to keep the rupee stable. The central bank would not want the rupee to appreciate because that would reduce export competitiveness, nor would it want the rupee to depreciate to protect the existing foreign investors. So, with an additional $20 to $30 billion flowing into the Indian economy, the RBI will have more foreign reserves, making it easier to maintain rupee's value. The fourth major benefit is that inclusion in JP Morgan's Emerging Market Government Bonds Fund could lead other major global indices such as Bloomberg and FTSE Russell to include Indian bonds as well. This can bring in more foreign capital, not just from passive funds, but also from active funds. Passive funds follow indexes and invest based on predefined criteria, whereas active funds have managers who make investment decisions. While JP Morgan's bond fund is passive, about $10 billion of new foreign capital from active bond funds has already been invested in the Indian bond market ahead of this inclusion. This is just the beginning of future foreign inflows into the Indian bond market. Increased demand for Indian bonds also increases its liquidity, making it easier to buy and sell bonds on the global markets. As more Indian government bonds are sold on international market, this will lead to more available capital, a more stable currency, increased foreign exchange reserve, a more liquid bond, and a lower borrowing cost, all of which will boost the Indian economy. Now that we know the advantages, let us talk about the risks of this inclusion. One major risk is increased volatility due to dependence on foreign funds. When there is headwinds in the global economy, foreign investors might choose to sell the bonds and exit the market, leading to increased volatility. However, this is not an immediate risk because the percentage of foreign investment in Indian bond market is low, and these are relatively stable passive index funds. Nonetheless, as the share of foreign investors increases, India's bond market performance will be tied to global economic conditions, political events, and changes in investor sentiments towards India. Major negative global events could affect the Indian bond market and in turn the Indian economy. The second risk is that the Indian government and RBI may have to align their decisions such as government spending and interest rate policies with the global investors in mind. They may need to balance domestic economic needs and global investor demands carefully. The third major risk is the creation of an asset bubble. Sudden inflow of foreign capital into the Indian bond market could lead to overvaluation of bonds and other assets such as stocks and real estate, causing inflation in the economy. While these risks exist, RBI has expressed confidence in managing them, stating, "We have managed it in the past and will manage it this time as well." In summary, the economic benefits of including Indian government bonds in global bond indices outweigh the risk. So, this is an important step in the right direction for the Indian economy.